On a previous video, I described tax-focused financial planning as like a high-performance bike. Today, these bikes may have as many as 27 gears, a far cry from my 10-speed bike of years past. How can today's high-performance financial bike help you? To begin, successful financial advice requires a multidisciplined approach because of the multi-dimensional issues at hand. The first dimension, or set of gears, relates to your goals and objectives. The next set of gears deals with how you want your money to work for you in terms of asset allocation, stocks, bonds, and alternatives. The third set of gears is asset location, which addresses which type of account, tax-free, tax-deferred, and taxable, is used. Tax-focused financial planning offers a fourth set of gears, your personal tax strategy. When linked to the other sets of gears, they enhance your ability to adjust to the changes in the financial terrain. The result is a smoother, more efficient journey, not only for you, but also your heirs. To me, the precision of these fully integrated gears is a beautiful thing. Unfortunately, too often, I see the opposite. The unsightly lack of coordination among the various parts of a financial plan. The following real-life examples demonstrate this lack of tax coordination. The first is a purchase of municipal bonds for a person in a low tax bracket or in a retirement account. Municipal bonds are fairly tax exempt, and many are also exempt at the state level. Because of this tax exemption, they typically provide a lower interest payment to investors than similarly rated corporate bonds. Investors in the highest tax bracket may be attracted to the municipal bonds because of the after-tax yield that results from combining the tax-exempt interest and their relatively high marginal tax bracket. However, investors in lower tax brackets purchasing municipal bonds do not receive the same after-tax benefit. What is really mind-blowing is to see municipal bonds in an IRA account that is already tax-deferred. This means that the interest that would have otherwise been tax-exempt becomes taxable at the time of distribution from the retirement account. Why would anybody do that? The second example has to do with buying an annuity inside of a retirement account. Annuities, which come with relatively higher expenses, offer tax deferral, but traditional IRAs already offer tax deferral. So the only reason to purchase an annuity inside of an IRA is to transfer risk to the insurance company. The risks that can be transferred to an insurance company include, but are not limited to, investment risk and longevity risk. If the annuity does not transfer adequate risk to the insurance company, then the investor is left with an expensive, long-term investment in their retirement account. Not a good idea. Finally, one of the cardinal rules of real estate is that it should never be owned by a corporation, neither a C corporation nor an S corporation. Regarding C corporations, gains and losses do not flow through to the owner's individual return. Consequently, the investor loses the preferential tax treatment of long-term capital gains rates, and losses are trapped at the corporate level, where they can only be used against future or past net income, if any. Regarding S corporations, it's difficult to deduct losses due to the way that basis is created in S corporations. Unfortunately, in real estate, losses can be large, so difficulty deducting them becomes a major issue. Tax-focused financial planning is about establishing and utilizing a customized machine with gears to help you through any financial terrain. It provides a smoother financial journey with less effort. If you would like help customizing your financial bike, call us today.